Welcome everyone. Today I am joined by Chris Treadwell of Mesa Financial. Chris is a development finance broker who some of you might know. He's quite prevalent on social media. And the idea of today's session is really just to talk about what we're seeing in the market at the moment, challenges over the next 12 to 24 months, advice to brokers looking to come into the sector, and then also working with developer clients and what advice you might give them. So this is really just a general chit chat. And hopefully everyone can learn something from it. So Chris, welcome. How are you, mate?
Hi, I'm very well. Thanks for inviting me on.
Cool, no worries. And so in first instance, it'd just be good to get started with those that don't know you, a bit about your background, pre-Mesa, pre-Avamore as well, and you know how you got started and what led you to where you are today.
Yeah, so I initially started off in broking a number of years ago, actually, but I've always been really honest, and people that work for me will know this as well. That when you first move into development finance, it is hard work. When you don't know what you're doing, it's a real tough. We're just mentioning there about you're talking about the reason for this is helping the broker community out. It would have been really handy to have had a bit more experience around me to show me the ropes and how this works. You kind of learn it on the ground. But background, started off broken, realised how rubbish I was at doing it, and that's the truth. I've been honest about that. And moving to a lender, worked at Avamore for about 3 years, which was a really good move, and it wasn't a planned move. It was really just someone I worked with at a previous firm moved there, and she said, "You fancy coming over on a 6-week contract?" And it turned into 3 years. I really enjoyed lending money. I have to say, it was a great experience. And the reason for going back to advising was, to be perfectly honest, it's just try and do it in the correct fashion, not be driven. And it's hard, but this isn't a charity, right? Everyone's trying to earn money, but to do it in the right way and offer the right advice to developers. And developers are, they're wearing a multitude of hats. And if with that financial hat I can add value, then I feel like there's a lot in wearing that hat as a whole, let alone all the other hats that they've got: planning, site procurement, dealing with contracts. There's so much. If I can get that part right for them, then it's value. It's a win-win for the client.
It's kind of like outsourced CFO, isn't it, really?
That for me is how it is. It's like cost consultancy is how I see it. I don't just sit there and get terms and say, right, there's your terms, let's go ahead. It's about looking at the wider business, understand how many schemes have you got on the go, what's your equity position. It's understanding the whole picture. This isn't just about a transaction. I try to get the wider, the deeper, and understand the plans as well. Well, if you stick this amount of cash in now, can you recycle X amount of cash on the next scheme? Do you need more leverage now? It's thinking ahead all the time. Well, I try my best anyway, but it's not always well.
Exactly. I know exactly what you mean. I think this space is definitely less transactional than the perhaps other parts of financial advice. This is more, like say, getting under the hood, understanding the business objectives and trying to put them in the best position. And so okay, so you're at a lender. Would it be fair to say then that perhaps you said before you didn't feel you were that good? The actual lender, you've then come to understand it from a very different perspective, and how funding works and the mechanics of that, is that gave you a much better understanding before then going into broking.
That's exactly it. I think with lending, I always look at ultimate lending as almost like a bit of a pyramid, where you've got your lender, your broker, your client, and then you've got your funders, then you've got your funders, and it's understanding how that machine actually works, where the source of funds actually derive from, how they work, who's, is it, how does this whole machine of funding work? Because when you're broker, you just make this assumption. I remember looking and saying, well, that lender obviously have loads of money in the bank and they just lend. And when you get into lending and realize actually that it's not necessarily just a license to print money, there is, the margins are slim across the board. And once you've got that understanding, you can then you can explain that to borrowers, because borrowers' perception is the same. If a broker believes it and they're in the industry, then of course a borrower is looking at saying they're greedy with fees and they're charging 10%. But when you explain actually there's only like 1.5% margin in there, and if you've got operational costs of X, they sort of say, I didn't realise that. And I say it's interesting information.
Yeah, it's like a lender's a white label, aren't they? They're a white label for someone with deeper pockets. So yeah, no, it's really good insight. The other thing I think that I just picked up there as well is that you actually felt you could add a lot more in terms of the advice side. I think I said to someone the other day, the difference between a lender. So some people, quite often it's normal for a developer to go back to the same lender each time because they've had a good experience or the transaction went well, whatever. But I think in the current market, especially because of like the volatility, there's huge disparity now between lenders where you can have, two lenders who might price the same 6 months ago, and now they're 3 or 4% apart just because of what we've talked about there, different capital sources and how they're funded. And some have been dislocated from base rate and others are firmly attached to it, and therefore rates have gone up. But I think that's really the point that of the advice, is that a lender is not your friend in the sense of they're not going to tell you whether someone around the corner will lend you more money at a better price, whereas a good advisor like yourself would actually do that. And that's massively important for your business if you want to be able to scale it quicker or be more successful, be more profitable.
Transparency is really important. I had a developer not so long ago, and he's very successful for, he's the same age as me, he's 30, about 34, 35. He's done very well, but he's sort of, and listen, lenders are there to lend money. Is that they're there to make a return. Well, and I think, everyone, we all know that. And I kind of see it as, I'm there to protect my client's interests and borrow from the right lender for the right project, and to make sure the kind of the puzzle fits. And he sort of mentioned, he said, my lender are this and they love me and they think I'm great. And I just laid it down and said, look, I'm not doing anyone any disservice, but they are there to make money. Never forget that. That is what they're there to make money. That is the sole purpose of their existence. And of course he looked at me a bit kind of, God, you're very very positive, but it's true. And I think it's right to be honest about it, because then they're there, they want your business.
And ultimately, yeah, they might look after you and invite you to golf once a year, but that money's coming from somewhere, and you've paid 10 times that golf ticket over the last projects, right? And some.
Relationships were tested during COVID. This is kind of what I picked up on with there were certain clients who had 10-year relationships with particular banks in the market, where a year before you would have had a conversation, they would have said, look, I've got 2-3 banks, we've got 10-year relationship, we've got someone internally who looks after all of our finances, and you're looking, we've got 3, 4, 5 million quid of cash in the bank, and you look and say, there's not much I can do for you for now, but let's keep in touch. But when COVID came, those relationships were tested when they agreed to lend, and then said, actually, we can only lend on the resi, not the commercial. And the problems start to arise, and the more problems there are, the more problems there are to solve.
I think also as well, the thing that always strikes me is how short memories are sometimes. So, you have lenders where if you've got one lender across multiple sites, they're cross-collateralized. If one of those sites goes wrong, then you're in trouble, because ultimately they can stop funding all of the sites. And I think that's where, I remember leading up to 2008, there were instances where I spoke to people and they go, oh yeah, I've got everything with this bank, I've got everything with that bank. And then speaking to them after the crash, and actually that became a big problem. And I think we've got a similar situation here where you're going into perhaps a downturn. Well, not perhaps, we are going into a downturn, but if you have got all your eggs in one basket, that could prove troublesome down the way.
I've been saying this to developers. I said this. I was with some clients in North London about 6 months ago, and all their eggs are in one basket. And I said, I said, like lenders spread their risk, they don't like to have too much exposure. I mean, that quantum of exposure could be 50 million, and for most developers, that will never be a problem for them. But if lenders have particular debt exposures they don't want, or caps, then so should borrower. I mean, there's hundreds of lenders in the market. you need between 3 and 5. You've got different sources of capital for different types of projects. Keep yourself safe.
Well, if you go to a financial advisor that's giving you advice on investments, how many of them will tell you to put every single penny you have in one company?
Always spread your risk.
Exactly. You're never ever going to get someone on a discretionary portfolio tell you to invest everything in one company.
A lot of it's like it. A lot of it's path of least resistance, right? When you've got it becomes, and you hear it's the same kind of body language. They say, "Oh, but it's just easy with them." I say, "But it's easy, right? Yeah. Is it right?"
I think, yeah, no, I get that, and it is, but I mean, I do also see as well where you can just with a little bit of shopping around, especially on. I mean, I've seen a situation recently where a borrower saved on a £7 million loan, saved £250,000 just by moving lenders, and actually, that's not pocket change, regardless of how wealthy you are as a developer. 250 grand, I mean, that's a decent saving.
It's your Range Rovers, right?
Yeah. And yeah, you might know the other person slightly better, but guess what? That lender do things almost exactly the same way. Yeah, you're going to make that kind of saving.
Economics, right? That's what development is. I don't know many developers who are in it for as like a community interest company. It's about it's a profitable business, and it's about
exactly. And I think the thing as well is actually when you start talking to developers about compounding. So if you let's say and I always think of it like this, most developers, if they've got a 20-year career, 25-year career, and they're doing one scheme every 2 years, that's 10 schemes. So if they leave 250 grand on the table every single time by not shopping around, that's £2.5 million.
Yeah.
But if you compound that, as in on the first scheme, I've wasted 250 grand by not shopping around. That's 250 grand in my next scheme where I don't get the 75% return on capital that I got on the rest of my money. So actually at 250 grand becomes, 400 grand or, in the next scheme. It then compounds further on the next scheme. And actually, by the time I've gone through 10 schemes, I'm not looking at 2.5 million. I'm looking at 5, 6, 7, 8, 9 million.
Makes absolute sense. But that again, that's about thinking ahead in the long term. And I think you get borrowers where for the type of schemes they're taking on initially with that particular lender, it's a great fit.
Yes.
It makes sense. It works really well for them. But like most developers, they scale. They start taking on bigger projects. They need more leverage and they need more quantums of money. And that is where that lender, it might not fit anymore. You need to have pools for different, it could be land with or without planning. That particular lender is having pools and sources of capital that you can you can move to as and when you need to, and not scraping around. This isn't the market, in my opinion, for developers not to be scraping around last minute. Have some organization around the initial part of understanding, can they assist me in what I'm looking to do? Whereas, a couple of years ago, developers are going, well, I've agreed to site an exchange, and you're like, and the market's awash with money. But now, I don't know, I think there needs to be a little bit more pre-planning. Yeah,
agreed. I mean, we always say as well, kind of, or I say to developers, think like a FTSE. Like if you're the CEO of a FTSE 100 company and you went to your AGM, they're right. What shareholder puts their hand up. Why did you change the company's banking facilities from this bank to this bank? Or why did we take a loan with this bank over this bank? And I think most developers probably couldn't stand up to any kind of scrutiny. Why did you use this lender when this lender would have done it better and would have saved you money? So, well, it's just because I know John and we've always been mates and we play golf together. Like, the shareholders are actually your family, because they're stakeholders in your business. That you probably have external investors. Most developers do. So if they actually did start asking those questions, could you defend yourself?
Really interesting. I like that analogy. That's really good.
Yeah. Okay, cool, mate. So getting on to if you were coming into the sector again, let's say knowing what you know now, what advice would you give to somebody perhaps who's looking to come into the sector, development finance? How do they meet people? How do they learn? How do they evolve? All of that good stuff.
first instance, and it's development fund. The best way it works is just to get started. It's to ideally have someone you're working alongside who has got a lot of experience in this, and just pick everything up. You will make and just accept you're going to make mistakes without a doubt. There is no. It's just not one of these industries where look back now at some of the mistakes I made and think, Jesus, like I look now and think it's common sense now, but at the time you're learning and accept you're going to make mistakes. And I think one of the other, it's not necessarily numerical stuff where I would say, you have to be a maths genius. I mean, I didn't do too well at maths at school, but I can certainly get my head around numbers pretty quick now. A lot of it's patience and tolerance, because this industry is driven, I think, with a lot of people, it's emotionally driven by money. Everyone has their own emotional attachment to money. Whereas when I look at spreadsheets, for me, it's very logical. And a lot of decisions being made is a lot of frustration in the industry and a lot of just being patient. I've got a deal that I'll close in 3 weeks. I've been working on it since February.
Yeah.
In my opinion, it should have closed a long time ago, purely on the basis that I was pushing for it to close because it made so much more sense.
Yeah.
The borrower had different ideas, and it ultimately knew where this would end up. But it's patience. It's just be patient and as tolerant as you can be. It can be frustrating.
I think patience and building relationships, and having like a much bigger pipeline than you think you'll ever need.
Yeah. I think honesty as well is another big thing that, like I said, there are anyone that's driven via sales, if your brain works that way, when you sit in front of a prospect, and they are a prospect, they're not a client, is when you sit in front of them, of course you want their business. When they're talking about these schemes they've got going on, they've just been funded by this bank at a £15 million loan. It's just, if there are no problems to solve, just be honest.
Yeah, I 100% agree with that.
Don't try and be the smartest man in the room. And these guys have got to this, and women, sorry, and they've got to this position not by sheer luck. They are smart people, know what they're doing. They will suss you out really quick. Just be honest.
Yeah, no, I agree with that. And I think also as well, is saying to them, look, I can't help you this time around. Let's stay in touch. Because I think to your point earlier, like where you said, there was somebody that you'd started working with, and it was 6-7 years till you perhaps do your first transaction. But eventually it comes good if you're honest and provide the correct advice when it's asked. Okay, cool. What advice are you giving to developers currently? So, firstly, let's say I've got a site, and I own it. I've got the planning. What should I do?
You own it already? Is it unencumbered?
I own it. It's unencumbered. Yeah. I can, world's my oyster. What should I actually do?
One of the first questions I would ask, if they were looking for leverage, it's fine. But my first question is, do you really need it? And it's not to talk myself out of businesses, but do you need to? And that is actually, I've got an example of that at the moment, of similar nature, where if you are cash rich, then, and you don't need to be borrowing, 7-8% a few months ago, and it's now 10-11+%. Do you need to borrow the cash? Do you need the time frames pushed upon you by that lender? Do you need to be under pressure? Well, if not, are you happy to use it?
And do I build now, or what do I do?
That's really to the developers. However, my question would be, I would ask that question. The question you've asked me, I would ask that. Do you really need to build now in this environment? It's volatile. It's changing constantly. Do you really need to? Personally, if I was developer and I didn't have to, I wouldn't be building. I wouldn't build now. But that's my own opinion. I know some developers are building now, and then the costs are certainly increased, but they're not put off by that. There's nothing. It's really different. Every scheme is so different.
Yeah. I had this conversation with another broker actually, and he was saying, developers are asking this question of him all the time, and he was saying what you've said really is it's very scheme specific and down to the individual as well. But phasing is obviously an option at the moment. Can you bring in, or can you develop a smaller number? HA allocation, perhaps you've got a small HA, can you increase it? And that maybe be your first phase, so you guaranteed sales, and then you do your private as second phase. The other thing that sort of came out of that conversation as well, which would be interesting to get your thoughts on, was whilst the conditions don't look great to be actually going into a build right now. I mean, build costs have fallen definitely, since the spring summer of this year, and also if you look at how Red Book valuations need to be done, it's very much on the comparables that are available at the time. So this broker was speaking to a client, and the client, basically the conclusion they came to was that actually the market conditions are probably better they're going to be for the next 2 years, because the comps are certainly better. The build costs are coming down. He already owned the site. And therefore, if he built it and it was going to take him 2 years to build, then actually probably should have ridden through the worst of it. And actually, if he sits on his hands for 2 years, then he's going to wait probably 3 years until the comps are back at today's level, so he can actually get the same level of leverage to actually build the thing. So actually, his options were build now, not in a great environment, but hopefully sort of be coming to the end of it when he actually delivers, or actually probably wait 3 years until the comps are at the level.
You mentioned in area when you said it's about the length of construction as well can make it. If it's a 6-month turnaround, then it's still quite a volatile period. But 2 years down the line, 2.5 years could be a completely different place, a much more stable environment. It really does, and it, like you said, depends on the nature of the asset as well. The asset class, what is it? Commercial? Is it resi, sale, investment? It's trying to but ultimately it's about understanding all those points. And but like you said about sales day, that's an interesting one. I've been having that conversation recently with a couple of lenders, and the market has been increasing for the past however many years now. And now I think I see an article. It's all doom and gloom, but an article say where it's dropped slightly. So I can imagine from really around the month now for another 6 months, when Red Books have done, then there may be a slight drop in GDVs once that 6 months data is in place. But for now, people are worrying about values. But I'm saying values have to use comps, change the numbers. They are what they are. So now they are fairly stable. Yeah.
No, I agree. I think waiting 6 months could actually be the difference between the scheme working and not in terms of the funding. Okay, last question. What are your market predictions then? Next sort of 24, 36 months, like where do you call the market in terms of where do you think rates will get to? When do you think they might start going down again? How would that impact on sales? What do you see? What should developers do over the next period of time vis-a-vis the land? We've talked before about pipelining, optioning land in the next few months.
One thing that makes sense to me is theoretic. I can't sit here and say that I've done it as a developer. But what would make sense to me now? The opportunity is looking to tie option agreements up based on residual prices as they are now, not what vendors think they are, what they actually are based on. Increased finance costs, increased construction costs, which is naturally suppressing the land value as they are now. And if you can hold out 18, 24 months and the market stabilizes by that time, interest rates start to come back down. As you've already mentioned, construction costs are already starting to come down, and that stabilizes back to some sort of market norm, whatever that looks like. You've built up such a buffer in that land value. You have such an option, then you can say, do we flip this or do we build this out? But you've really built that buffer in there, which has always made sense to me. I think at the moment, buying stuff with planning off the shelf, I don't know, because every scheme I look at that's off the shelf doesn't work. It's overpriced. The profit on cost is way too low. I think interest rates will be, what the last 2 years has taught me is, before I was a lot more certain on points in the economy, I just don't know where. It's really hard it's really difficult. So much has happened over the past couple of years that, like, real big stuff, like you got a war in Ukraine, soaring inflation, a global pandemic. Who would have expected that to take place? And it has. And I think the advice I would have now is to any developer, when you are looking at your appraisals, is absolutely have, and not all appraisals do, absolutely have your sensitivity analysis in there for GDVs, construction costs, and include one for finance costs, or Speak to your broker and they will do it for you. Start looking. If you're floating above that Bank of England base rate now, then, you know, I was on site not long ago in southwest London, and they are floating, and they are, you know, construction costs are very expensive. It's cost them a lot more than they expected, and finance costs are increasing as well. So you know, you're getting hit from all angles. So
Yeah.
absolutely have that in there and know where you are as best as you can to the pound.
Yeah.
And think ahead the next 6 months. If rates do hit, they do start hitting 5, 6, calculate what does that mean? This is money out of your pocket. Keep saying to developers, this is money out of your pocket. This isn't theoretical. This potentially is money out of your pocket. So at least understand what that could look like for you. If you are thinking of, you know, you've got £500,000 of profit coming out of the scheme and you're looking to recycle that cash. Well, actually, if these construction costs and finance costs impact that to 300, what does that mean for the next scheme? Can you transact? And it's all those sorts of questions.
Well, it goes back to what we were talking about before, almost like the business plan, isn't it?
Yeah.
You know, if you're looking at the next 10, 20 years, your retirement plan, if you like, how does losing 200 grand from that now, from this scheme, translate to what you can do over the next 9 schemes, and how does that compound then across all those schemes as well? It actually has huge.
The other advice I would say, and it's stuff I've picked up on in the last sort of year or so, it's not necessarily like a just lender spread. We've mentioned that, which I think is really important. It's also just things I pick up, and I do pick stuff up. I've got a good eye for detail on certain things, and it is a professional team. You know, I've got clients forking money out for consultants on stuff, and I'm sort of saying, how did the meeting go? And I'll try and get to as many as I can to sort of see what this individual's like, how do they operate? It could be a planning consultant. And spoke to a client recently, he said, well, I don't feel like we made any progress, and he didn't really give me a plan moving forward, or a planning consultant is there to advise you on what to do, not the other way around. And he said it was the other way around, and he said, I've just paid like 7 grand. And I said, cut this nonsense now. We'll put you in touch with a proper planning consultant who's been doing this for 30 years. He knows the local council. This is what he specialises in. I think that's another point, is really professional team. Are they, because when the cogs are turning and things seem to be working, you just keep going. It's the path of least resistance. But when there's problems, especially like you mentioned with delays in planning, they're using the right consultants. Might not be the plan, it might be the consultant. So start with business and who is in it, and is there maximum value add there.
Think like a footsie.
Yeah, think like a footsie. I like it.
Cool. Okay, mate. Well, look, thanks for joining me, Chris. Great insight, and hopefully helpful to some of the brokers and any developers watching as well, to give them you know, the inside track on how it works on the broker side.
Fantastic. Cheers, Ian. Thanks a lot.
Thanks, mate.